I mean, the music is absolutely fantastic. So Tom Orlik really explained some of the premise of what we'll do in the next half an hour. We have 30 minutes to try and address some of the fundamental questions around debt sustainability. What, if anything, drives leaders to confront the debt spiral? Who ultimately pays the price? How will these disorderly events in global debt markets reverberate through other asset classes and the broader economy? So I'm so delighted to have A-list panelists on with me. Mark, let's start with you. How much more tolerance do you think there will be for the U.S. continuing to expand its debt and deficit?
I think a limited amount from here. And I think, depending upon how things pan out, America is probably beginning to think about fiscally consolidating. If tariff revenues are as large as they might be, that could be 1% of GDP next year. And if that money is applied to reduce the debt and start fiscally consolidating, if they're able to create some level of Goldilocks, some level of growth, and they're able to drop interest rates so the debt service bill drops, they may not test that hypothesis. Ironically, I invest in emerging economies, and everybody tells me, they have much better debt statistics and dynamics than the US. That's all true. But depending on how the US applies this experiment, it might actually start fiscally consolidating. Subject to some of the stimulus in the One Big Beautiful Bill Act, you might find that the US starts to consolidate a little bit, which is given the huge expansion through the original Tax Act back in good old COVID, the 12 trillion of money that was pumped into their economy over the last 8 years would be quite interesting. So I think we may be at a point where the US may start to consolidate a wee bit.
Yeah, Lim Hwee Hua, how do you see this developing? Again, the U.S. has loads more debt since COVID spending, since possibly, this big, beautiful bill, but foreign capital may also move away from U.S. assets. So does this feel like a recipe for disaster, full stop?
Well, I think many countries and many governments in Asia are trying to grapple with the level of tariffs in the country. And I think the fact that the U.S. has taken on more debt, I think it has led to a lot of U.S. dollar-related fluctuations, which I think many of the governments in Asia are also trying to grapple with as well. Yeah.
John, do we actually get to a tipping point? How do we know when we're at a tipping point, for example, for the U.S.? Mark's laughing over there because he knows the tipping point.
John knows it.
I think to level set this, just to remind us all, if we even look at let's start with the G7. We're at the same level of debt that we were at the end of World War II, from a global point of view. And the reason for that is, of course, the world took on a lot of debt. It was very expensive following the global financial crisis in 2008, and then subsequently the pandemic in the late teens. I think this is a chronic problem. I don't think it's an acute problem. I think the forest is smoldering, but we're not at the edge of the cliff. I think what we need to keep in mind is, and I have commented to Bloomberg that I thought that the title of this panel was a bit dodgy and that it was just debt sustainability. It actually should be debt sustainability and the global social contract, because what this is all about is governments around the world have a social contract, particularly in the developed world. And Mark and I were talking about it's emerging in some parts of the emerging markets where populations are aging, people are expecting pension, healthcare costs and the uncertainty of AI and how that's going to affect all these things are causing governments to have more expensive programs. And we look at the G7, more than 60% of annual budgets are entitlements. And I think this word entitlements, it's one of those words that politicians don't like because it's like handcuffs. We can't do anything about entitlements. It's pensions, it's health care, and it's other type of social welfare benefits. But the reality is, those have to be thought about in the context of how they're paid for. And it's interesting, Francine, we're here in Singapore, where you've got this extraordinary model of having a government that set aside a very large amount of capital that has become, I think, 20% of their annual income as a result of having a sovereign wealth fund. So this is actually a very good test case for prudent fiscal management.
So there's a QR code if you want to ask questions, and I also am going to put all of the audience to work, so I have a polling question. But first, there's a first QR code for questions. Lim Hwee Hua, do you agree with what John was saying?
Yes. Well, I think it comes really, well, I mean, it's not just the US. A lot of countries have taken on increasingly more debt. So it comes really at the expense of long-term infrastructure development, healthcare, education, defense, and welfare benefits as well. Yeah.
So to the polling question, because that kind of puts everything into context, although I will ask, Mark, where you see the tipping point for U.S. debt and what you're monitoring. But this is a polling question. So what's the most realistic way? There you go. This is a QR code. What's the most realistic way to break the cycle of runaway debts? And again, this kind of goes back to the idea that John was talking about for the social contract. So A, spending cuts on social programs, not very popular. And I know it's politics that is driving economics, but not popular. Major tax increases. B, also not very popular politically. C, legally binding budget caps. We may talk about the UK. And then D, investing in growth and productivity. So whilst everyone is voting on that, Mark, if we just quickly, briefly go back to U.S. debt, how do you monitor something happening on U.S. debt? Like, when do we know we're close to a tipping point?
The markets will tell you. I mean, if you think about what happened in April, there was a moment when the curve didn't behave quite like it should do, when there was a risk-off moment. There wasn't enormous amounts of buying at the long end. It didn't react exactly how everybody expected. And that's telling you that the markets were much happier staying in the short end, thank you very much, and looking to apply their capital when they felt other things were being managed. So the markets will be the first thing that tells you. And it's generally the markets that hold governments to account. For economies that are based on running deficits and having market access, if there's a hint of no market access, things tend to happen. Yeah. And it changes governments. You saw it even happen in the UK.
And the US, I mean, the Treasury auctions are still functioning in a very stable, if not robust way. So the U.S. government's access to finance is still very strong. I agree with Mark, but I would also say that you have to couple that with the word confidence of government. The markets pay attention to leadership and confidence, of course, from the, whether it's the Treasury Secretary or the Chancellor of the Exchequer or Finance Minister. It's a question of confidence.
Yeah, I was just going to say that the other signal would be when countries get downgraded by the rating agencies for the extent of public debt as well. Yeah.
Yeah. Could we, but I mean, if you look at this like holistically, Mark, could other countries witness a Liz Truss moment? I mean, that was pretty ugly for bond markets. Yeah,
they definitely could. I mean, one of the questions in the UK at the moment is that we're about to get another one. You definitely, yeah, I mean, John's right. Confidence is what drives markets, and markets get ahead. They definitely could. If you're a country that's running deficits and relying on market access to do it, if you get a loss of confidence in your market, it doesn't just reprice it, and you get any kind of bias strike in parts of the curve. It's a real problem for you as a government running that deficit and managing it. We could definitely get that.
Do you think we
But the Liz Truss moment, actually, I think you don't have another Liz Truss moment. You don't have a dollar shock or whatever if you're anticipating it or you're trying to.
You're ready for it.
I think also in the Liz Truss moment case, I think that was about a third Liz Truss and 2/3 LDI. So I think as a practical matter, I think you have to think about that going back to the markets.
Maybe. But those moments, as you say, once confidence is gone, you have a real problem. You do get a market shock.
But it's this combination of taxes, programs in terms of spend, including, as you say, defense, and how the government is, whether the government does or does not have borrowing capacity. And all those three, the market will have an opinion about all those three.
Yeah, I mean, markets have a lot of opinions. Lim Hwee Hua, who do you think is at risk the most in terms of countries? Or, I mean, could we see a Liz Truss moment in the shorter term or medium term, and where?
Oh, well, countries at risk are the ones who are taking on more debt. I just want to make the point that there's a shortage of political will because long-term infrastructure expenditure doesn't square with the short-term nature of politics these days. And people are just, or rather political parties are just wanting to get re-elected for the next 4 to 5 year term. So they don't have the appetite to do anything that is long-term in nature.
And this goes to the polling question, which is interesting that 54% of you here in the room think it's investing in growth and productivity. That takes time, right? It's maybe something that in an election cycle, you sell it, but you don't actually see the benefits, John. And to your point, it's kind of what's needed.
Well, that's a secular.
Political will.
Investing in growth and productivity is a 5 or 10 year scenario, and people don't necessarily, people don't think about that, and that is certainly not the political cycle.
No.
And I think that's the issue. And I think that the most interesting part of this whole panel is when you look back in history, the most innovative things come when you have a crisis, whether it was the Depression and Franklin Delano Roosevelt and how robust he was at all the programs that were put in place in the United States, or even in 2008, I can remember I was managing the restructuring there. You had the PBOC, the Treasury, you had all the major global banks and all the governors on the phone every Monday afternoon. And the world was very much coordinated. I don't see the world as coordinated today, and I think that's something to pay attention to.
So do you think if there was a big crisis, central banks wouldn't act together?
Well, I'm not going to say they're not going to be, because the world is going to hear my comment, and then people are going to say, why did he say that? I would say that I think there was a degree of chemistry and rapport in 2008. And remember, a lot of this is, and I just finished Andrew Ross Auckland's book, 1929, and he has a very profound paragraph in there, which he says, at the end of the day, there's a human factor which people believe the markets would never, ever disrupt or go down. They would always continue to rise. So I think the thing that comment, 2008, it was a group of central governors, all of whom liked each other, respected each other, and got on. And that's why it worked. This is still, in terms of all these issues we're dealing with, this is still about people.
And trust. Mark, which is most at risk? If you look at the US, Japan, France, and the UK, who do you most worry about?
Well, Japan has gone on the path to start consolidating. It's gone from 250% debt to GDP down 230%. So that's promising. Although we're about to see what comes with the new Prime Minister, and that sounds like we could have quite a big stimulus program. So is that consolidation going to continue? Don't know. But progress so far has been good from a high peak. The UK, I think, feels pretty controlled by the market. I think the UK is very nervous of the market. So I think the market is quite significant for them. So I think there's a chance that they do the right thing.
There's a big budget next. I mean, it's November 26th, so we're really a week away. What are you expecting from it?
Well, they've tried really hard to have it in public for about a month, like a sort of a little polling exercise. I think it is going to be some level of consolidation, but probably not as much as the market would like. So I don't think the market will be super happy about it. We are other countries with France and...
US.
Well, France is I think the market's going to make EU rules, and the market is going to make France do some level of consolidation. The offset to that is that there's going to be a lot of European stimulus around defence and infrastructure built. So that will be an interesting level of where that comes from and whether the borrowing is French-driven or German-driven. In the US, as I say, I mean, obviously the US is the global reserve currency, and that gives it a lot of reasons and a lot of benefits. I think it really depends how big these tariffs are, what they do with them, what level of import substitution. So those tariffs get given to people's bank accounts, which is one thing we're hearing, more helicopter money. That, I think, is a bit of a problem and will add to the inflationary risk there. So it's what happens in tariff, and also what happens in productivity around the AI story. Some of that is short-term quite deflationary. You might get some inflation later on around bottlenecks in terms of supply chain for the raw materials and power, but initially some of that's quite deflationary. And some of that seems to be having an impact already in sort of mid-level employment in the service industry, so it's quite quick impact. So the US, I'm always concerned about because it's big and ugly and everything has been priced off it historically. But it really depends whether they do get the joke and start to fiscally consolidate and stop kicking the can down the road and saying, we're fine, we can just issue paper. Yeah. So it was very interesting 2 years for the US, I think.
Lim Hwee Hua, can lower debt nations actually benefit in this kind of scenario, in this kind of environment? So where does it look safe? What about this nation, Singapore, which has a AAA rating? How much of a difference does that make?
Well, I think Singapore is still watching, particularly between the US and China geopolitics in terms of what new tariffs, and the tariff effects, because we're a trading nation. So we depend a lot on trade for our livelihood. Yeah.
John, how do you see this playing out across the world? Like what nations will benefit and the ones that you worry about the most that will lose out?
At the risk of repeating, just to go in what Mark was saying, the U.S. and the U.K. operate on fiscal annual deficits. Germany, Japan actually have fiscal annual surpluses. France, the issue there is it's going to be a question of leadership, where there has to be some political conviction about where they want to take the country. But it has a lot to do with, there are certain parts of the world we're already seeing where robotics and AI are causing marginal disruption in terms of unemployment. So I think this whole question of social contract will become much more of an issue across the world, particularly if there's a spike in unemployment. I think longer term, let's just level set here. The U.S. is still the largest economy in the world. It's the most liquid. It's the most transparent. It's the reserve currency, and it's going to remain. It's going to be there's going to be a continued challenge by other parts of the world to look at alternatives to the dollar, but there's nothing that's going to rival the dollar as reserve currency in the short term. The other question I should have answered earlier is, you said, when you look at very powerful economies, what's a good indication of an inflection point? In the United States, when the debt service cost exceeds the defense budget, it's always something to pay attention to. And that happened about 18 months ago. Now, when you mention that to the White House, the reaction is, well, we're going to increase the defense budget.
But John, I mean, the other thing is that you have big corporate giants like Microsoft and Airbus who basically can borrow at cheaper costs in their countries of origin. I mean, that really changes quite a lot, right? The perception of risk in there. And again, is this something that, what can countries do about that?
Well, I'm not surprised that the likes of Amazon and all that can get much cheaper debt, because they are valued, on their own basis. But I think I'm just concerned about the increase in debt by many countries, and taking on of more public debt. And I think at some point it will have an impact on the capital markets as well, because you have financial instruments, real estate, they're all interconnected with capital flows.
Mm-hmm. Mark, when you look at the super narrow spreads on corporate bonds, what are they telling us about country debt?
You mean how tight they are? It means people are looking for other places to put money, and they feel that they may have a lot in underlying country debt. I think it's definitely people looking for other places to put cash and to try and get a pickup over what they see as very tight sovereign spreads as well.
Is there, John, in all of this, it's basically you need policymakers to be courageous enough to tackle this and maybe be straight with the populations about the social contract. Who do you think, is there some, are there nations that are doing this properly?
I think you only do this from this is like asking turkeys to vote for Thanksgiving or Christmas. You're not going to do that. This doesn't, it's a difficult thing. It's why it's never part of a political agenda, because people focus on this as a negative. You're going to cut healthcare costs. You're going to cut pensions. You're going to restructure. But I think if you look at countries that are dealing from a position of strength, we're now living in an environment where you do need to think about the demographics have changed. The structure of work has changed. People are working longer. The role of technology and AI and how that's going to affect the cost of healthcare and the role of insurance. All of these variables, the social contracts of a lot of these countries, particularly the G7, they were set 75 years ago. So it is time to proactively think about these social contracts. And I realize you can't do it in the middle of a crisis. And actually that's why politicians feel it's going to have to come from people who have a strong leadership backbone.
Lim Hwee Hua?
Yeah. Well, policymakers are driven by what the politicians want, right?
Yep.
And so I'm a little pessimistic, because I think political will is in short supply at the moment. But what it means is that for the markets, for investors of the international markets, you need consistency in valuations, in order to make sense of what the underlying value is of each business. Yeah.
Mark,
or maybe, I'm sorry,
no, go ahead.
But maybe that's mostly true, and it's very important for big economies that they don't have huge crises. Yeah. But maybe the way to really get change is a really big crisis, because then people within that country start thinking about, well, what is our social contract? We've hated our government. They're all terrible. I hate all governments. They tend to vote in somebody from the outside who, if they have some logical thing, can say, listen, we need to take some pain here. It's not my fault. We blame all the other guys. We need to start running a surplus. We need to cut government spending or government departments like that. And maybe that people, when it gets bad enough, realize that their social contract is broken and they're prepared to suck it up a bit to try and move forward. If part of the quid pro quo of that is democracy. And I guess Argentina is going through that now.
Yeah, it's an interesting comment, because we've had this debate a lot internally, and when you actually get different groups of people together, you almost think that this whole issue of the fiscal debt profile globally is something that's going to be resolved by a different generation of people, a much younger group of people. When you talk to Generation Z about this, they have a very different view of debt and the need to balance the budget.
Okay, we're almost out of time, so 2 quick questions each. First of all, how much do you worry about the growing popularity of private credit? And then if I give you $1 million each, well, Bloomberg will give you $1 million each. Where do you invest it, Mark?
Oh, boy. Thanks for that. Which one can I answer?
Both in 20 seconds.
Okay, well, let's focus on the $1 million. I always want to focus on the money. It depends on your timeline and your horizon. I'm busy qualifying my answer before I give it. I look for some level of stability in terms of environment and regulation. I try and look for some level of certainty in terms of policy, because I don't want to invest just day trade for 10 seconds. If I want to day trade, that's a different thing, and you follow momentum all the time. So I guess if I'm looking for growth, I'm looking for equities in emerging economies, and I particularly like some of the middle-level emerging economies that are getting more scale and are busy building their own domestic consumption. What was the first question?
Private credit. How much should we worry about that?
Yeah.
How much do you worry about that?
So we look at private credit in a slightly different way, I think, to the popular term, in that we think very long-dated private credit is actually a key part of growing the utility sector, the infrastructure sector of emerging economies. So private credit, particularly driven by pension funds who need long-term assets within emerging economies, is a great thing as long as you match the liability to the asset. So long-dated is good. Private credit, as it's sort of grown within the US and Europe, yeah, I mean, if any asset class that you're not marking to market and pricing, I mean, it's just very, very risky. And when the music stops, it stops.
Lim Hwee Hua, where do you put £1 million? Or dollars? You can even choose your currency.
Well, I suppose it depends on ultimately the sovereignty of each country that I want to invest in terms of private credit. And across the different markets, I mean, equities and so on, then obviously the liquidity aspects would still be important.
John?
The question?
£1 million. Where do you put it right now? Where the social contract is holding?
I put in a hybrid portfolio. I think you've got to look at high quality private credit. I call it private investment grade, really.
Wonderful. What a fabulous panel. Thank you so much for joining us. Thank you.
Thank you.
Thank you. Thanks for having me.
Thank you.